Nobody quits real estate because it doesn't work. They quit because they weren't prepared for all of the different things that go wrong. In this video, I'm walking you through the most common issues that you will face when investing in real estate, and more importantly than anything, how to go about handling them without losing money or without losing momentum. And at the end, I'll show you the one issue that blindsides almost every single new investor, even some of the smart ones. So, are you ready for the problems that come with building real wealth when investing in real estate? Let's dive into some of the issues. Number one is overpaying for the deal. Now, this is the most common mistake beginners make. They fall in love with the property, they just absolutely love it, and they try to justify the numbers. They end up convincing themselves that even if it's a tight deal, that appreciation is going to save them. And here's the thing, it won't. If you don't have proper cash flow and things like that, if you buy wrong and you start out behind, it's a recipe for disasters. So before you make an offer, you have to know the true ARV based on recent comps. You need realistic repair estimates. You need to understand your exit strategy, and you need to know your minimum profit margin. Never negotiate based on what you hope. Negotiate based on what the actual numbers say. Real estate forgives a lot of mistakes that you can make, and that's one of the nice things about it, but overpaying oftentimes is a quick way to disaster. Issue number two is underestimating the repairs. Now this one can really hurt your bottom line. You walk the property and you think, this doesn't look so bad. And then the contractor opens the walls and all of a sudden you have all of these major problems going on. You've got electrical updates that need to be done, plumbing surprises, structural issues, HVAC replacement costs. I've got a deal right now where I'm having to replace 2 HVAC units. And here's the thing you need to think about. Whatever you think the repairs are going to cost you, add a buffer to that. Experienced investors typically are going to build in 10 to 20% of contingency. We use detailed scope of work, and we have contractors walk through before we actually close on the property. Now, you don't want to get hurt by repairs. You don't want to underestimate them. So you have to make sure that you're really factoring that stuff in. By the way, quick pause here. If you want a clear framework for buying, renovating, renting, refinancing, and repeating that process the right way, be sure to grab my BRRRR Mastery Guide. It walks you through the numbers, the steps, and the common pitfalls so you don't learn the hard way by making those mistakes and spending and losing a lot of money. It's completely free, and I've got it linked in the description below. Now, let's keep things rolling. Issue number three is cash flow doesn't match your expectations. I see this a lot as well. This one can really sneak up on you. You run the numbers, it looks great on paper, you're excited, and then all of a sudden reality starts to hit. You've got vacancy, you've got maintenance, you've got property management, you've got unexpected expenses that you didn't factor in. Here's the tactical adjustment to that. You always want to calculate for vacancy, a lot of times 5 to 10% for this. Maintenance reserves, capital expenditures, property management. Even if you're self-managing the property, you still need to factor in for property management. If the deal only works in the perfect scenario, then that means it's not really a strong deal. Issue number four is inconsistent deal flow. One deal every 6 months is not a business. It's just kind of like luck. And if you don't have consistent lead generation, you really don't have consistency in your income. And as we know, that's a bad thing. So you need direct-to-seller marketing. You need a very dialed-in follow-up system. You need networking with other agents and other investors. You need ongoing pipeline tracking, those sort of things. Full-time investors do not wait for deals. We generate opportunities. Issue number five is making emotional decisions. This is one I see quite a bit as well. You really you want to make the deal work, and so you stretch your numbers, you ignore a bunch of the red flags that pop up, you try to justify risk, you rush decisions. Emotion can really kill margins. And so the best investors are going to stay calm, and you're going to be willing to walk away, or you can renegotiate if you have to, and they kind of slow things down and not make rash decisions. If you can't say no, ultimately you're going to pay for it later. Real estate isn't risky because of the market. It's risky because of poor preparation. Think about it. If you buy at the right price, if you estimate your repairs properly, if you run conservative numbers, if you build consistent deal flow, and if you remove emotion, you're going to dramatically increase your odds of winning on the long term. Here's the one issue that blindsides most even smart investors, and that is that they underestimate how mentally tough this business really can be. Deals fall apart, contractors will ghost you, tenants complain, lenders that you've been working with change their terms and conditions for getting loans. And if you expect perfection, you're going to quit. If you expect problems and prepare for them, you'll stay in the game long enough so that you can win. That's the difference. If you're serious about getting started the right way, I also have a free 2.5-hour course in real estate investing that walks you through every single possible thing you would need to know step by step. Now, this is completely free and it's linked in the description below. If you're ready to stop guessing and start actually building something real, that's your next move. As always, thanks for watching, and I look forward to seeing you on the next video.